All right, let's talk about one of the most popular and honestly one of the most misused indicators in all of trading, the stochastic oscillator. Today we're going to transform this thing from a tool that probably causes you a lot of headaches into a much sharper, more reliable part of your trading plan. Let's jump right in.
I bet this looks familiar. The stochastic is way up in that overbought territory. It's screaming at you to sell. So you do, and then you just watch in pain as the price keeps rocketing up without you. It's a classic and super frustrating scenario.
But here's the thing, that's not just bad luck. It's not the market being unfair. It's the market punishing a surface-level understanding of what this indicator is actually telling you. See, most people are just chasing these signals without really getting what the stochastic measures. And it's all about one thing, momentum. So let's get right to it and expose the biggest mistake people make, what I like to call the stochastic's big lie. Once you understand this, everything else starts to click into place.
Here it is, the big trap. In a really strong trend, a stock or a currency or whatever you're trading can stay overbought for a long time. So selling just because the indicator pokes its head above that 80 line often means you're literally trying to step in front of a freight train. And, well, you can guess how that usually ends.
So what's the right way to see it? Let's totally redefine the stochastic oscillator right now. It is not a crystal ball for picking tops and bottoms. It's a gauge. A powerful gauge for measuring the momentum of the market. And once you see it like that, the whole game changes.
You know, this tool was developed way back in the 1950s by a guy named George Lane. And his whole idea was that the stochastic doesn't follow price, not directly. It follows the speed of the price, its momentum. And his genius insight was that momentum almost always changes direction before the price does. That's the edge it gives us.
So the indicator itself is pretty simple. It's just two lines. You've got the blue line, which is called %K. That's the fast one. It tells you where the price closed right now compared to its recent high-low range. Then you have the red line, %D. That's just a smoothed-out average of the blue line, and that's what we often use as our main signal line.
And of course, you have the famous 80 and 20 levels. Anything above 80 is what we call overbought, and below 20 is oversold. But listen, if you take away one thing, it's this. These are not automatic buy or sell signals. Just think of them as zones, areas where the market's energy might be getting a little stretched.
Okay, let's get into our first actual strategy. And honestly, this one filter is the most powerful thing you can do to immediately cut out most of those annoying false signals and improve your results.
It's the oldest saying in trading, and it's a cliche for a reason, because it's true. Momentum on its own is kind of meaningless. It needs context. And the overall market trend gives us that context. Using the stochastic to trade against the main trend is like trying to swim up a waterfall. You're just not going to win.
So here's a dead simple way to get that context. Just put a 200-period exponential moving average, or EMA, on your chart. The rule is incredibly simple. If the price is above that line, we're in an uptrend. We only look for reasons to buy. If the price is below it, we're in a downtrend, and we are only looking for reasons to sell. That's it. You just eliminated half of your potential bad trades right there.
All right, on to our second core strategy, spotting divergence. Now this is cool. This is when there's an argument, a disagreement between what the price is doing and what our momentum indicator is doing. And this little argument often gives us the best clues that a reversal might be coming.
So what is divergence exactly? Well, it's when the price makes a new high, for example, but the stochastic indicator makes a lower high. It's the market basically whispering to you, hey, this move is running out of gas. But remember, it's just a hint. It is not a command to trade. You always have to wait for the price to prove it to you.
Now, there are a couple of types of divergence, but the most common and powerful one to look for is regular divergence. That's what we're going to focus on today, because it's that classic signal that warns of a potential trend reversal.
So how do we spot it in the wild? Check out this chart. See up top? The price is clearly pushing higher, making higher highs. But now, look down at the stochastic. It's making lower highs. That's a classic bearish divergence. It's telling us that even though the price is inching up, the actual power, the thrust behind the move, is fading. It's a huge warning sign.
Okay, now for the really fun part. We're going to combine everything we've talked about, our trend filter and our divergence strategy, into one single high probability trading plan. This is your go-to checklist for finding quality setups.
Here you go. It's just 3 steps. Step 1. Identify the primary trend. Is price above or below that 200 EMA?
Step 2, wait for the stochastics to give you a signal in the direction of that trend. So if we're in an uptrend, we're waiting for a pullback into that oversold zone. And step 3, you wait for confirmation. This could be a crossover of the lines, a bullish divergence, or the price breaking a key level.
Let's walk through a real example with Bitcoin. Okay, first thing we see, price is way above the 200 EMA. So our trend is clearly up. That's check 1. Second, we get a nice pullback that sends the stochastic way down into the oversold zone below 20. Check 2. And finally, we get our confirmation when that blue %K line crosses back above the red %D line. All 3 steps line up. That's a high probability setup to go long.
Now, let's look at a common mistake using a gold chart. A trader sees the stochastic is overbought and gets that sell signal from a crossover. It looks really tempting, right? But what did they forget? Step 1. The price is still cruising way above the 200 EMA. They ignored the primary uptrend, they tried to fight it, and they probably got run over for a loss.
And that brings us to the final, and I would argue, the most important piece of this whole puzzle. You can have the best strategy on the planet, but if you don't have the right mindset and risk management, you will never be consistent. It's just not possible.
These are the rules that truly separate the pros from the amateurs. You have to remember that patience is a position. Sometimes the best trade you can make is no trade at all. You have to wait for your signals, for your confirmation, and crucially, you must define your stop loss and how much you're willing to risk before you ever click that buy or sell button. This discipline is what stops you from making those terrible emotional mistakes.
This really is the heart of what we're talking about today. Real confidence in trading doesn't come from one little indicator flashing green. It comes from having multiple independent reasons, like the trend, the momentum, the price action, all lining up and telling you the exact same story. So, if you remember just one thing, please let it be this. Stop thinking of the stochastic as just a simple overbought/oversold indicator. Start seeing it as a precision instrument for gauging market momentum. When you combine that insight with a real structured plan, it becomes one of the most powerful tools in your entire arsenal.
And now I really want to hear from you. Have you had success with the stochastic oscillator? What kind of strategies or confirmation tools do you like to pair with it? Share your best tips, share your war stories down in the comments below. Let's all learn from each other. Thanks so much for hanging out today.